Start now. So hi and welcome everyone. Welcome to this webinar organized by Eurodat and is titled Sovereign ESG, that's Environmental, Social Governance Bonds to Close the Climate and Sustainable Development Goals Financing Gap, a critical introduction to their limitations and risks. So this webinar builds on a Eurodat report published in December 2023, which was titled Sovereign ESG Bonds in the Global South, 10 Questions for Those Concerned About Debt and Climate Justice. And one of my colleagues will just post the link to the report. The report was written by one of our panelists today, Andre Standing, and it's designed to provide an introduction to what ESG sovereign bonds are and how they are being used as a way for Global South countries to close the so-called financing gap. So Andre will provide a comprehensive introduction to the report, and I won't give you any more information on the subject. But what I will do is start with a brief introduction to the panelists and the flow of today's discussion. So we have 4 expert speakers today, starting with Andre Standing, who is an independent consultant and expert on climate conservation and has written a lot on the subject, including on the role of conservation in relation to innovative financing instruments. So Andre will start with a 20 minutes presentation, which covers introduction, the background, context to trends in ESG sovereign bonds and what they actually mean for the financing, development finance in general, and climate finance. After Andre, there will be a 10-minute intervention by 3 expert speakers. We will start with Professor Celine Tan. Celine is a professor of international economic law at the University of Warwick, and she's done extensive work on development finance, climate finance, debt restructuring, and the global financial architecture in general. Celine's intervention will focus on the rise and efficacy of ESG bonds in context to issues of emerging regulatory frameworks. So it's good that we start with the legal perspective. Following Celine, we have Carola Mija. Carola is a climate finance analyst at Latindat, and Carola's expertise on all things climate finance, including at the UNFCCC, has been extremely useful for all of us. And Latindat has also been doing a lot of very interesting webinars on climate finance, development finance with a geopolitical focus, and I encourage you to have a look at that. Carola will reflect on the situation in Latin America and raise some questions on the viability of issuing ESG bonds in this context. So Carola's intervention will be finally followed by Yolanda Fresnello. Yolanda is Policy and Advocacy Manager of Debt Justice at Eurodat. Her expertise on all things debt and climate is extensive, but in the 10 minutes she will focus on the rise of ESG in context to the escalating debt situation, and also make the links between ESG and debt swaps based on a report that she authored for Eurodat a couple of months ago, and that report should also be in the link. So after these 10 minutes interventions, we will open the floor for Q&A and ask you to please prepare some questions for the speaker. And now I hand over the floor to Andre. Over to you, Andre.
Great, thanks very much. I've prepared a few slides. Hopefully they'll come up in a minute. If we can kind of expand those. Yeah, perfect. So the background of this report was we wanted something to give an overview of this emerging ESG bond market. And I think it's quite important to stress that these are just one financial instrument that are being used as in a way of raising private finance to help development or climate finance or biodiversity financing. And they exist alongside lots of other things, such as the debt swaps that we just had mentioned, and other forms of, kind of biodiversity offsets, carbon trading, all sorts of innovative financial instruments. But ESG bonds are a mainstay, and they're promoted in various different forums. And over the last kind of decade or so, there's been this surge in interest and an idea that the ESG bonds are going to provide a lot of additional funding for very positive things in the Global South. So Eurodat contacted me to write a report on this, and we came up with the idea that we've structured around 10 questions because there's quite a lot of people who are interested in this, but not necessarily very sure what these bonds are all about. So our report goes through these 10 questions. It's quite long and quite technical, so I won't be able to go through everything in this brief introduction. What I've done is I've teased out a few key issues from our report, and then I'm leaving it with some kind of bigger picture questions, things that I find difficult to answer, but very interesting. Our report is not necessarily trying to provide all the answers to these issues. It's really an introduction, I think. So the first slide here is my best attempt to try and give you a little introduction into what these ESG bonds are. And it's quite a confusing landscape and very changeable. It started off, the first, kind of the birth of ESG bonds was after the financial crash in 2008, when European Bank of Development and the World Bank launched these bonds that were designed to raise private capital to spend on climate financing projects. And then they called them a green bond. And after that, a few other corporations and development banks issued similar bonds, and they called them also green bonds. And then from green bonds, people said, well, this is a good idea. We can come up with all sorts of labels to market bonds as kind of positive, kind of ethical bonds. And then on this left-hand side, you see how this has proliferated. And we want to distinguish between two main types of bonds. On the left, we've got what's called use of proceed bonds. And very simply, that's when an issuer, someone who wants to raise money, says, look, I'm going to spend all this money on something very positive. It's either going to be green focused, and then later on, people said, well, we could raise these for social things as well, such as spending on gender programs, on social housing, on health, education. So within this green ethical bond market, we have social bonds as well. And then more bonds, different labels have been introduced. You've got things called blue bonds now, which are bonds raised for marine conservation, ocean issues. And then outside of this is a transition bond, which is money that people, organizations raise to transition themselves to being greener organizations. Now, as these bonds were being developed, there were various efforts to kind of regulate the bond markets. And on the right-hand side here, I'll give you three examples of the main kind of labeling schemes that exist. The main one was developed by the World Bank with others, and it's now implemented by the International Capital Markets Association. Then you have a climate bond initiative, which is based in the UK, which provides a sort of certification of bonds. And then most recently, the European Union has issued its green bond principles and green bond label. Now, there's one type of bond which I wanted to isolate, and it's called their performance-based bonds. Unlike the use of proceeds bonds, where a company or an organization commits to spending all of the money on this green or social thing, performance-based bonds are money that's raised and it's linked to key performance indicators. So the repayments to the investor will be determined on how successful the bond is. And again, you've got those linked to social things, those links to wildlife conservation, forest projects, and it kind of overlaps a little bit with REDD+. One of the earliest examples of this was what's called a rhino bond. And it was conservationists in Southern Africa who went to investors and basically said, if you lend us money, we'll pay you extra if we save more rhinos, and we'll pay you less if we save less rhinos. So it's a form of gambling a bit on the financial markets. And what I wanted to stress in the report is this is a fairly chaotic landscape, and investors, bankers who come up with these labels, they do that first, and then regulatory bodies react and try to provide standards and principles to try and organize this later. So we can move to the next slide. So one of the dominant themes about ESG bonds is that they've gone through this massive growth in the last 10 years. And a lot of people are very positive about ESG bonds, present this as if it's quite an exciting development, that we're getting billions of money now flowing into green and social bond markets. Our report, casts some doubt on that and tries to say, well, what does this really mean? What does it, when you see this graph on the left, this spectacular growth. I think in 2001 was a record year when there was $1 trillion of ESG bonds issued that year. You say, well, it looks very impressive, but two caveats. The first one is that ESG bonds still make up a very small amount of the global bond markets, right? So if you were to add up all the bonds that are sold by multilaterals, sovereigns, corporates, ESG bonds make up around 3 to 4% at most. So, we're not seeing a massive greening of financial markets through the ESG bond kind of segment. It's still a really niche product in financial markets. But then even more worrying is this graph on the right-hand side that comes from a piece of research written by American academics who are looking at what has really happened in the ESG bond market. And what they're showing is that as it's grown, the bonds, this is just on green bonds, this graph, the bonds have become less green over time, and they've had more disclaimers, more legal disclaimers added to them, which basically means that the issuer says to the investors, look, we're going to spend this on green issues, but don't hold us accountable. We might spend it on something else, or we might not be very successful. So I think when we see this growth in bond markets, what we're really seeing is a growth in labeling of bonds as ESG, not necessarily that these bonds are doing anything necessarily more green or social than it was in the past. And a way of thinking about that is looking at the World Bank. The World Bank is one of the leading issuers of ESG bonds in the world, in particularly around multilaterals. And they're saying that more and more of their bonds are ESG labeled, but they've always been raising bonds, for decades. So why weren't the other ones ESG bonds? They should, all the money that the World Bank is raising and spending is going to be around poverty reduction. So it could be labeled as a social bond. This is just a labeling effect we're seeing in the market. It's not necessarily that lots more money is going into positive spending. So next slide, please. So in our report, what we wanted to do was look at what's called sovereign bonds. They're bonds that are issued by the central government, and look at what's been happening in southern countries. And I want to stress that in southern countries, a lot of bonds are issued by corporations or subnational governments. And we were quite, just focused on central government bonds. And we compiled a crude database just from our own research. And we put that in an annex in the report where we've found what we think are most of the sovereign bonds issued from up until 2023. We haven't updated that recently. And I just want to give you an idea of some of the trends. So you see in the first graph here, the first ESG bonds were issued around 2017. That was by Nigeria, who issued a green bond, and Fiji, who issued a green bond. And they were kind of, proof of concepts. They're the first ones, got a lot of publicity. They were for quite a small amount of money. And then gradually the number of bonds has grown. It's still not a huge segment of the bonds that are issued in total by emerging economies or southern countries, but they're growing. And clearly 2021 was a bumper year for ESG bonds. And that's largely, I think, due to COVID. Most of those bonds issued that year were for health, and some of them were even labeled as pandemic bonds. So in the middle here, what I've done is I thought it'd be interesting to kind of show you what type of themes, because a lot of people, when they hear ESG bonds, they think of green bonds, and that a lot of this money is going into environmentally themed spending. Whereas in fact, what I found by looking at the ESG bonds from sovereign issues, most are actually going to social spending, education, health, those sorts of things. And it's actually a minority that's going into purely green issues. Blue bonds is an emerging area where there's a lot of interest. There's a lot of kind of financial market experts are predicting that blue bonds are really going to take off in the next few years. And then the purple bit is the sustainability linked bonds, which I'm going to talk a little bit more about in a minute. On the right, to give you a few examples of the big borrowers. And you can see Chile really went crazy with ESG bonds in 2021 and 2022, and they issued almost half of the value of all ESG bonds from southern countries. So there's a few leading countries. And what I think is interesting is that least developed countries, the poorer countries in the world, are not really using these bonds. The only good example has been Benin, who issued a Sustainable Development Goals bond last year. But generally, poorer countries aren't issuing them. And I think that's largely due to the scale of the debt crisis in a lot of poorer countries and the fact that they're not being able to access private financial markets that easily at the moment. So the next slide. One of the themes I wanted to pick up on in this report, which I found really interesting, and I've seen it myself. I lived in Seychelles and worked in the Seychelles for a while during a time when the Seychellois issued a blue bond, was just how much donor support and efforts are going into these ESG bonds. And I think, very superficially, we see these as private market finances. But when you get up close to them, you realize that this is really blended finance in a lot of cases, and that there's a lot of subsidization going on in these ESG bonds. So I wanted to describe in the report what is the role of some of the key donors, the UN agencies, World Bank, some of the bilateral donors like the UK. And it's surprising just how much they're involved in this ESG bond issues. And I've put this in a little kind of circle demonstrating all the points that they're involved in. And that's, it starts off with setting these international standards. Then there's advocacy. There's so many conferences and technical working groups, a lot of NGOs and consulting firms getting money to do work in developing countries to promote ESG bonds. The donors are designing how the bonds are going to use the money. They're providing credit guarantees to try and lower the interest rates on payments. They're paying for things like bankers' fees, the second opinions or the kind of verification reports on these ESG bonds. They're organizing roadshows for governments. They're also buying bond notes of some of them. So they're actually putting the capital into the market to buy these bond issues. And then they're also involved in implementing the projects and then auditing the projects. And this cycle just goes around. And I think it's an interesting point, not only to see that this is a blended finance, but also some of the conflicts of interest that exist in the ESG bond market. Nigeria, we mentioned in our report, is a good example, where it was one of the first countries to issue a big green bond, mostly in the forestry sector, and it was backed by a lot of UK money. And when, after 2 or 3 years, there was a conference in Nigeria saying, how well is the green bond doing? And local researchers and NGOs are saying this money is not being spent on what it was supposed to. There's no evidence. It's gone missing. But the UK had put so much money into it that this conference and the report that came out of it just basically said this is an amazing success and other African countries should do something similar. And I felt that, this is indicative of how much has been invested in the success of these ESG bond markets. On the left-hand side, these are all probably familiar to you, but when we're looking at the advocacy and all the promotion around ESG bonds, what are the themes that are being advocated for or promoted? One of them is this idea that ESG bonds is going to be the key instrument to help bridge this funding gap. You're all familiar with that, the idea that there's this enormous amount of money that needs to be raised in the world to save forests, to protect biodiversity, to transition to green economies, and so on. They're also marketed as being a cheaper source of financial capital for developing countries, and I want to talk a little bit about that in a moment. They're also advocated as a means to diversify investors, that, developing countries are told, if you market an ESG bond, you're going to appeal to a much wider group of investors than you normally would. Often countries are told that if you do these now, you're going to be showing the world you're a leader in your field of, whether it's in blue bonds or forestry bonds or whatever. There's a sort of sense of, you're showing your responsibility to the world. And then there's this underlying economic theory of ESG financing can be critical in, achieving this virtuous cycle of green growth. So you borrow, you invest, you grow, you can pay it off, you can borrow, you invest, and you're creating this green growth. These presentations are often extremely optimistic and very superficial, I find. Next slide, which I think is my penultimate one. So this greenium is something we pick up on in the report, and it's this idea that developing countries can access private finance at a lower rate because of their ESG bond, decision to label it as an ESG bond. And it's quite important. I think the idea that compared to a normal bond where developing countries tend to pay very high interest rates, that somehow if they market it as an ESG or a green or a social bond, that they can get cheaper interest rates. And we looked at that and it's not very compelling. The reality is that ESG bonds, just like any other bonds, are determined by credit ratings. There are all sorts of variables that influence a price of a bond, but credit rating is the main one. What we do find is there is strong investor demand. So there's lots of investors that would like to buy a green bond issued by a developing country, but that doesn't result in interest rates coming down. What it can do is it can encourage governments to borrow more than they should do because there's so much demand for them. So there's quite a few examples where a country has said, we want to raise 500 million to finance this green program. They've gone to the market and says, who wants to buy this? And there's been so much demand. They've said, okay, well, maybe we won't borrow 500 million. Maybe we'll borrow 1 billion. So they're actually borrowing more than they should. And I think that's quite important from a debt perspective. The other issue that I think is quite important is that these ESG bonds are actually quite expensive. There's a lot of things that need to be done to verify them in reporting and auditing. And those costs actually outweigh any sort of marginal slight decrease in interest rates that countries might get. So one of the messages we wanted to put into this report was that a lot of organizations are saying ESG bonds can be a mechanism for something like climate finance, but they're really inherently unfair because credit ratings are higher for the most vulnerable and most climate impacted countries in the world, including small island developing states. And these countries are going to have to pay more to access that than any other country. So it's really the antithesis of a just and equitable system of climate finance. Next slide. Hopefully I'm doing okay on time. I haven't put a time on it, but I'll try and wrap up quite quickly. No, can we go back one?
Yeah.
So very briefly, and it's something we were talking before we went on air. I think we've missed a slide, but I wanted just to talk a little bit about sustainability linked bonds, these ones which are based on performance indicators, because I think these are gaining a lot of interest, and I feel that we're going to see more of these in the future. The two big ones that have happened so far have been in Chile and Uruguay. And just to give you an idea of how that works, Uruguay will borrow, say, $1 billion from investors, and they will say they're going to spend this money to increase the forest cover in the country. And they'll say to investors, if we don't meet this, we're going to pay you extra. And there'll be a structure to those payments. So after 5 years, if they're below their promises, they're going to pay a little bit more to the investors. And by the end of the bond, say 10 years, they'll have to pay another extra penalty fee to the investors if they don't meet this pledge. I think these are going to become more common. I think there's a few reasons why they're popular. One of them is that investors like the idea that they are putting their money into something which has a tangible accountability mechanism, so there's not this greenwashing risk that countries will say they're doing something green and they don't. A lot of people think it is a discipline to this bond that really linked to very clear measurable indicators of success. If countries get their gamble right, they can get below market rates. They're saying to investors, if we're going to do all this, you need to reward us by letting us pay you less money. There's also, unlike the use of proceeds bonds, there's a lot more flexibility. Governments don't have to commit to how they're going to use it, that money. They can do anything they like with the money. All they're committing to is improving on these performance indicators. So they're a lot more appealing for governments than use of proceeds bonds. So generally, they're seen as this kind of a compromise between ESG bonds and, as Eurobid has been writing about, debt swaps as another extreme. They're somewhere in the middle. So they're seen by a lot of people as being an exciting new stream of financing. I think we in our report raise a number of concerns about this. How financial markets are moving towards some sort of gambling system where governments are, enticing investors with these promises to pay them more if they fail and pay them less if they win. There's a lot of questions about this system. Of course, when governments fail, they're going to be paying above market rates, which seems to be inherently unfair. There's very little accountability in how the use of the funds are in SLBs. And there's a lot of possibility for greenwashing in a different way. And I'm sure lots of you listening in are familiar with RED Plus and carbon trading. And one of the ways, fraud in these markets is by companies and governments inflating the baseline of what their performance indicators, basically saying things are really terrible. So if you're going to pay us on our performance, we're going to achieve those wins because we've basically inflated how bad things look. And already in Uruguay, that seems to be apparent. In Uruguay, the bond was sold with the idea that it would increase forest cover to a certain percentage of the country's landmass, whereas actually it was already pretty much there when they released it. They used data from over a decade ago as their baseline. So basically, they were trying to get rewarded for something they've already done. So I think SLBs are really important, and I imagine that they'll become a bigger issue. I think they're going to become particularly used for meeting the UN biodiversity target on enlarging protected areas. So countries will be borrowing money and paying back investors a bonus if they fail to deliver on meeting biodiversity targets. Right, so the final slide, and hopefully I haven't gone on for too long. These are sort of big issue questions that we might want to discuss on the chat and with the panelists, things that I find really interesting. The first question, are these bonds better than what I call vanilla bonds, usual bonds that aren't ESG labeled? Probably is the answer to that. There are some aspects of them, they're a bit more transparent, it's a bit more reporting, but it's marginal. But I think it's a valuable question to ask. ESG bonds are better than non-ESG bonds. Are they optimal solutions to the funding gap? And we could talk a lot about that in different contexts, but I think for a lot of countries, these are quite easy access to private finance, which should be for things that should be funded in a different way, or there are different ways of raising capital and finance than borrowing at quite an expensive rate on financial markets. So, in small island developing states, which is I work on a lot, you would say that issuing an ESG bond is often a suboptimal solution when there are much better ways of raising capital, either through charging more resource user fees, carbon taxes, taxing, increasing income tax, all those sorts of things. An ESG bond, really, if you look at their options, is probably low down and a high risk. Then I wanted to, flag this issue, which we do in the report, about this underlying theory of this funding gap. And I think a lot of organizations, including civil society organizations, take this for granted, that we need a massive increase in finance to save the planet and create kind of social gains, but also environmental gains. And I personally feel that's a very simplistic message. And once we unpack that, it starts to undermine the logic of a lot of ESG bonds. The area where I work a lot is on ocean conservation. And there, lots of organizations are saying, we need to increase spending by billions of dollars every year to save the oceans. Whereas my view is that in most of these countries, the reasons why the oceans are being unsustainably managed has nothing to do with a lack of finance. It's to do with too much finance. It's to do with political corruption. It's to do with, very unfair resource sharing. So just simply imagining you can spend lots of money on solving it, which so many organizations seems to say, is very simplistic and misleading. I also think there's a really interesting area of research on what are the implications of when you start financing sectors such as marine or forestry through ESG bonds, whether they encourage forms of financialization in those sectors. The handing over of those sectors to asset management firms who are designed to create profit in order to repay the bonds. And I think that they can have a very negative and corrosive effect on certain sectors being relied on, these ESG bonds. So I'll just leave it there. Hopefully I've given you enough. I haven't covered everything in our report. There was 10 questions, and I think it would have taken me an hour to get through all of them. But hopefully that's been enough to set the scene for our expert panelists to respond.
Yeah, thanks a lot, Andre. That was really helpful for me. I think one of the contributions of the report was this question of ease of access to finance through this new novel instrument, and then actually checking the reality of the so-called financing gap. And the questions you raised in the last slide were really interesting. I'm going to hand over to Celine, but before I do that, just a reminder to all the attendees that please put the questions in the Q&A box, which is right in front of you in the screen, and the chat box is different. So please come in, Celine, for your intervention, approximately 10 minutes. Sorry for the time.
Thanks a lot, Farwa, and thanks, Andre, for a really excellent presentation and report. It's a really really much needed report, I think, coming out. So thank you for doing that, and for all the forensic details that you've gone into the report. I'm just gonna, so I found the report very informative, and the key takeaways, I think, from a regulatory governance perspective, for me, was that, one, there's a growing market for label bonds, and the regulatory framework for this market is uncertain, it's fragmented. I'll come to some of the risks of that in a minute. Secondly, this market, particularly in developing countries, are being constructed by the public sector through donors, through international financial institutions, and the role of these institutions in the public sector are twofold. First of all, the need to align financial flows with SDG or climate initiatives. And so therefore there is certainly a move to create enabling environments through regulatory reform. We'll talk a little bit about the risks of that as well. So that's the first way that I see the public sector certainly constructing markets in this way. The second point that was also raised in the report is that they do it through investment. So either by issuing bonds themselves, which we see with the World Bank and other multilateral development banks, but also creating these investable pipelines of bankable projects where, which the bonds can fund, right? And the third takeaway from the report really is about this construction of this market being driven by the narrative, as you put it so nicely, this gap talk, basically, Andre. I know Patrick Bigger and colleagues have kind of, constructed this notion of this gap talk, the movement from billions to trillions, the kind of like the narrative that we've got to get from A to Z, and the Z being a massive, like increase in the amount of financing available that public funds can't match. So those were my three takeaways from the report. And so what I want to do here really is actually to draw on some of the findings that I've kind of come up with in a paper that I wrote, and I can put the link to that in the policy brief in the chat in a minute. But to sort of outline this risk that the move to reliance on financial markets to fund sustainable development and climate action poses for developing countries, right? And particularly from a legal regulatory governance perspective. And the two, I think, regulatory issues that these sort of like proliferation of what I call green sustainability and social bonds, the GSS bonds, so I use kind of the term, GSS bonds rather than ESG bonds, but they, interchangeable in this definition. So I think the two main regulatory issues I see are firstly the governing of these bond markets. So the governance, like how these bond markets are governed, the issuance of the bonds, how they regulate it, how do you account for the use of proceeds, how do you account for, meeting benchmark indicators for performance-based bonds, etc. So that's the kind of how the finance is being governed. And the other thing, which is also interesting for us, and I think there's something to think about, is how does this shift from public finance to these kind of financial markets for SDG and climate action changes the governance structure in itself at the domestic level and international level. So what I'm saying here is it's the governance by finance, not governing finance, which is the first part of it. How is finance being governed? But the second part of it is how is finance governing other areas, right? And has impacts on other regulatory mechanisms within, domestic international settings, and how does that help us or hinder us in achieving SDGs and climate action? And what I mean by this is that when you shift the modalities of finance, particularly for critical public goods, right, you are shifting the governance and regulatory framework through which civil society engages with the governance structure of the country, the policy space, the regulatory space. So in many respects, this shift from public to private markets really is shifting the way that developing countries are engaging with financial actors, with the financial system, and with their own domestic constituencies. Okay, and there are four, I think, main risks to this kind of transition, which I'll just lay out. The first risk of this is that when you shift from primarily public resources, and we see that because, obviously developing countries are being moved off sort of, there's no money for concessional lending, or there's no money for grants, so we're gonna, use whatever limited funding we have for that to de-risk your issuing of GSS bonds to increase your capital for SDG climate finance. So what this shift does, it also shifts and undermines national ownership and alignment with national development plans and national development priorities. And I think you can see that in a sense that local communities don't actually have control over where the public expenditure is going to go to, right? It may be rooted in a national development plan if, for example, the issuance of a GSS bond is rooted in a development plan and it funds parts of that budgetary requirements, etc., all well and good. But oftentimes they're not, as we will know, because they have to be designed and delivered with investor appetite in mind, right? Like what will sell? What would investors want to invest in? We see an increase in investor appetite. Why? For certain types of product, maybe dolphins are great, elephants also maybe, but not so much rhinos. I don't know, who knows with these things, right? It's so when you have a situation where bonds are being designed for the private market, you also remove the local community participation in what money is being raised for and what use that money is going to be put to. Okay, so that's the first one. The second risk is that there's a fragmentation of the financing sources, and that leads to a lack of standardization in the regulatory framework. It leads to fragmentation in fiscal accountability mechanisms, and importantly, the regulation for these products, as Andre actually shows in the report, it's a lot of it is being driven by private industry actors. It's through very opaque trans-governmental networks, if there are any. And the global financial system is being regulated, unlike in trade and investments or other areas of international economic law. You find that certainly with international financial regulation, a lot of it is emanating out of very opaque processes, right? And there is a great industry input into these, and very little opportunities for civil society to sit in, right? Or communities to have open conversations and discussions about what those regulatory standards should look like. So the standards are designed by, you know, the International Capital Markets Association, the ICMA, the Green, the CBI, the Climate Bonds Initiative, etc. All these are very closed door standard setting mechanisms, and they close the door and weakens accountability, I think, and input of developing countries and civil society groups in the design of the rules that will ultimately impact on countries, right? And I think this has an additional impact in terms of redress mechanisms, because if you look at public sector financing in institutions from MDBs, for example, or donor countries, there are public oversight mechanisms, ombudsmen, you know, you've got the, you know, whatever concerns and reservations we have about the inspection panel system at the World Bank, for example, there is notionally a framework for that. What happens when finance is delivered primarily through financial markets, particularly in countries where perhaps you don't have robust public administration, ombudsman system, accountability mechanisms, and also public law systems that aren't as robust for judicial accountability, judicial review of governmental action, etc. So there's a huge problem with accountability there. The third issue is, and I don't want to, I'm very conscious of time, so I'm going to go through it very briefly, is that reliance on capital markets exposes developing countries, as we know, to shifts in the global economic environment, right? So you create new transmission nodes for financial instability, not only for the country that's issuing and then being integrated in financial markets, but for financial markets as a whole, because they're all integrated. You're asking institutional investors, pension funds, etc., to be investing in GSS bonds, right? Without necessarily augmenting or reforming the global financial architecture, which is just going to percolate along without any new regulatory mechanisms. And we see how well that's worked out in the successive rounds of financial crises. We see, for example, you know, the massive capital flights that happened, you know, in 2020 from developing countries, so the capital outflows. Now, when you have such important things like SDG, health, education, climate being funded through these financial markets, financial instruments that is reliant on financial market sentiment without the necessary regulatory reforms to the global financial architecture, I think this is really risky and really problematic. And the fourth and the last risk, I think, that we need to think about as well is that, again, this whole movement of financial markets to finance very fundamental global public goods is not really matched by, you know, again, reforms in the debt restructuring, debt architecture, right? So you have an issue where there is no ex post rules-based system for dealing with sovereign indebtedness. What happens, you know, when a sovereign is indebted? I mean, these products, these GSS bonds, are pretty much have the same standard terms and conditions as plain vanilla bonds. Okay, they might have KPIs for performance-based loans, they might have some use of proceeds requirements and that, but when it comes to dispute settlement in these, what happens when a country cannot meet their contractual obligations? There are no specific contractual innovation within those bonds to make it easier for countries to restructure, to make it easier for countries to enter into an orderly restructuring process with these private creditors. And there have been introduction of things like climate debt clauses, debt pause clauses, so the climate resilient debt clauses, CRDCs, that have been introduced by UK Export Finance and the World Bank in some loans. I mean, those are official loans. They're not integrated into any new sort of like climate GSS bonds or green sustainability bonds. Those are not contractual terms that have been introduced in those bonds. And I think that's really critical because, you know, you have all these bonds doing the supposed good stuff, but why isn't the, you know, more progressive elements of, you know, contractual provisions being built in to what happens in a case of a dispute, or when a country cannot pay its claims, sorry, cannot pay its obligations when it's debt distress. So I'm just going to leave it there, but I thought this might be, these are really crucial issues that one needs to think about when we move from public finance to financial markets for funding very critical public goods. Thank you.
Thanks a lot, Celine. I like the term rules-based order and the disconnect between new instruments and the whole debt restructuring mechanism. And now I pass on to Carola. Carola, please come in.
Thank you very much, Farwa. Thank you, Eurodat, for the invitation. On behalf of LatinDat, we are very happy to be part of this event. And congratulations for this report. This is very interesting and very important to have this information. And I would like to start mentioning that these ESG bonds are being promoted with the narrative that they are innovative and they can close the financial gap that we have for climate finance and also for the fulfillment of the SDGs. But there are a lot of things there that need to be questioned. And one of them is that ESG bonds are going to add more debt to the countries that are already highly indebted. So that is one thing. And the other one is, and I will share a couple of slides. I didn't have the idea to share them at the beginning, but I think it's easier to understand if you see the figures here. And it is estimated that the world needs between 3.3 and $4.5 trillion per year to achieve the SDG objectives. And the financing gap to achieve the SDGs in developing countries is estimated to be between $2.5 and $3 trillion per year. So it's a huge amount only for the 2030 agenda. And a problem here is that most industrialized countries are not fulfilling their commitments to mobilize 0.7% of their GNI as official development assistance. So there is something that we need to be concerned of, that these countries are not really fulfilling their commitments, their international commitments. And the other thing is related to climate finance, which is the topic I will cover more in my intervention, because until 2030, global South countries need between $5.8 and $5.9 trillion to fulfill their national determined contributions, their climate commitments. They need between $215 and $387 billion annually for adaptation. So we have a huge need also for adaptation, and that's something that I want to point out a lot. And $4.3 trillion per year for clean energy. To make this green transition, we need a lot of money, but unfortunately there is international commitment of only $100 billion annually, which hasn't been fulfilled by the industrialized countries. So of course there is a huge gap. Rich countries are not fulfilling their commitments. They are mobilizing most of climate finance through loans. 72% are loans worldwide and 81% are loans for Latin America, and even for adaptation. And that is very unfair because it keeps adding to our debt burden. And that is a big problem. And it is really unfair that the Global South is really paying for the climate debt of the countries of the North, even with high interest rates. So those are two problems I wanted to highlight. And going back to what we were discussing, these bonds are becoming quite popular. They are being used also in Latin America, as Andre was mentioning. Chile and Mexico were the first ones to issue green sovereign bonds. Colombia was the first one to issue a green sovereign bond in local currency, which was quite interesting. Ecuador was the first one to issue a social sovereign bond. And Chile is the big leader in the region with a huge issuance of this kind of bonds, social, green, sustainable bonds. But at the end, we have to analyze what are these resources going to, what are they investing in, which sectors? And when we have a deep look in Latin America, we can see that around 50% is going to energy projects, renewable energy projects related to the green bonds. and only 1% is going to adaptation, for example. And that is a big problem that I want to highlight here now, because adaptation should be a priority for global south countries like mine, Bolivia, which right now it is facing a lot of climate impact, extreme impacts. We have passed from extreme drought to flooding in just a couple of days, and this is really affecting us. And green bonds are really not helping in adaptation. For example, just only 1% is going to adaptation, and that should be also because when you need to repay these bonds, you need to invest in projects that can give you profit. And of course, renewable energy projects can do that, but not adaptation, not water resilience. And yeah, that is something that I wanted to highlight in my intervention. And also, well, another maybe good thing is that some countries, like the ones that I have mentioned, Chile, Mexico, Colombia, Uruguay, Ecuador, are developing some legal reference frameworks to issue these kind of bonds, which could be good, but it is really highly risky. And in a context of countries like mine, Bolivia, we really don't have good public information. So there is the risk that there won't be good public information to really know what these bonds are funding and how this money is being used. So the transparency issue is a very important thing to question in Latin American countries. Maybe in some other regions like Africa could be the same problem. And I completely agree with Andre saying that there should be other options. For example, at the national level, ESG bonds are a sovereign decision. If they want to issue this kind of bonds, they can, but they could have another different options. For example, the carbon taxes, the green taxes that could disincentivize big polluters and could be helpful to have a national climate finance to invest in some adaptation and mitigation projects without increasing the debt burden. That is very important. And of course, it is very important that rich countries and developed countries fulfill their commitments, because otherwise this huge gap is just going to be bigger. The burdens are going to be worse every time. And I know Yolanda will develop more on the debt problem. But ESG bonds are really not the big solution. This is a problem and something that maybe the multilateral banks are promoting a lot, but it is I don't really see them as a big help for our countries, and especially considering that climate finance, for example, should come from mostly public grants in recognition of this historical climate and ecological debt these countries have, and as a form of preparation of all these impacts that we are receiving and we are suffering right now. And it's not fair that countries themselves have to find their own solutions to solve this inefficient and unfair international financial system that needs to be reformed. I completely agree with what Celine was also mentioning. And we need another big reform in the climate finance architecture, which is being inefficient, is causing problems, is very difficult to access, and is increasing the debt burden, as I mentioned. And of course, the fulfillment of commitments is something that we really need to be questioning and criticizing a lot at the international level. So I will stop there. Thank you. Thank you very much.
Thanks a lot, Carola. And I see there are a lot of questions in the Q&A for the panelists to choose from as well. And before that, I move on to Yolanda. Yolanda, please come in.
Thank you. Thanks a lot. Can you hear me? Yes. Okay. Well, I would like to start by thanking Andre for the excellent work in the briefing. I know it was not easy because of our timelines and back and forth. But as Celine mentioned, I found it very instructive. I really learned a lot by reading and working with Andre and Farwa in this briefing, acknowledging and when we wanted to put this briefing out there, it was acknowledging that there was a gap in information and knowledge in the civil society community around this increasing focus on ESG bonds, and I think the briefing covers a little bit that gap. Our intention is also to use this to identify what is the way forward. So I would appreciate if people would also send comments to Eurodat in that regard. I also would like to start my comments on something that you, Andre, said, which is that these bonds are presented as additional funding for good things. And I think this is very key because they are neither one or the other. They are seen as additional funding to cover this financing gap. But what we are seeing is that normally it's countries that have market access, but that go from issuing vanilla bonds to issuing ESG bonds so they can get a better price, which, as Andre was saying, it was not the case in most cases. So it's not additional. It's just a new way of issuing debt, and it's not for good things because most of it is being used to refinance existing debts because there is no way of tracking where the proceeds of these bonds are being invested on. And in some cases, it's openly refinancing debts. So the objective is openly refinancing debts. And this is extremely problematic because it's making the snowball even bigger in a context of already a debt crisis. And as Celine said, the problem gets even bigger when we know that there is not a functioning debt resolution mechanism in place. So when the moment comes when countries might have difficulties to repay these debts, the debt restructuring process is a chaotic, savage process in which only the ones that can pay the better lawyers are the ones that get the better results, and that is normally the creditors and not the debtors. Because even with CACs, with collective action clauses in the bonds, debt restructuring is extremely difficult, as we are seeing in the cases of Suriname, of Sri Lanka, of Zambia, of Ghana these days. The second issue is questioning that the access of the accessing the markets through this ESG bond issuing is going to cover the so-called financing gap. Because first of all, it is countries that have market access that can issue these bonds. It's not countries without market access that suddenly can issue green bonds. It's the Chiles and the Uruguays of the world that can. So middle-income countries, emerging economies that already have market access, and they want to improve the conditions of that market access by issuing ESG bonds. So the money is not going to those who most need it, so who have the biggest financing gap, but to those who already have market access. The second issue is that it is being presented also, as I said, as a way of refinancing existing debt by throwing more fuel into the fire, and therefore making the problem even bigger down the road. This is particularly relevant these days when we are seeing several proposals on the table that frame the context not as a debt crisis, which is what civil society is saying, but as a liquidity crisis. So saying, okay, we have a liquidity crisis, countries have difficulties getting access to resources to get the ball rolling, including repaying existing debts. So let's open the markets for them. Let's help them open the markets. And this is where these instruments of credit enhancement, of guarantees, of public support that Celine and Andre were mentioning come forward. A very relevant case of this is the debt for nature swaps, which are presented as a proposal to tackle both debt problems at the same time as in the last cases, marine conservation, but that they are really refinancing instruments. Debt for nature swaps are operations in which there is an issuance in the last cases of Barbados, Ecuador, Gabon, and Belize, issuance of so-called blue bonds. But the proceeds of these blue bonds are being used to buy back existing debts, in most cases, not in all cases, at lower interest rates than the existing debts. The problem is that the savings of that difference between interest rates are being used to pay the transaction costs of the operation, so the intermediaries of the debt swap. And in all of these operations, there is the element of the credit enhancement, so the guarantee by a multilateral bank or international development institution that facilitates the operation and guarantees that the creditors will be repaid in the case of a default. I wanted to also tackle on the issue on the last question that Andrew posed in the center of those questions, which is reject or reform. I think we should do both. We should reject ESG as the solution for not the financing gap, but the needs, the financing for development, the needs that global South countries have because of the structural, the economic structure in which the world functions, because of the climate impacts, therefore a responsibility of the global North. So issuing green bonds or issuing social bonds cannot be the answer, because these resources should come from those that cause the problem, which is global North countries. But meanwhile, these bonds are being issued, so we should call out for governing the bond market. We should call out for better accountability mechanisms. We should call out for regulation of these financial mechanisms. So at the same time as we say these are not the answer to the problems, the financing for development problems in the global South, we should also be able to call out for regulation in the financing markets. I'm going to leave it there because I'd rather have people participate, and also Andre answering all of the questions in the chat. Thanks a lot.
Yeah, thank you, Yolanda. Thanks to all the panelists. As I said, there are almost more than 10 questions now, and they're all very important. So maybe what we will do is share the questions as well with all the audience afterwards. But let me just distribute a few questions to the panelists. So the first one is for you, Andre, by Miriam, in which she's talking about ICMA's lobbying worldwide, and especially in the South, to have no binding regulation, but countries accepting its weak voluntary ESG bond standards. And what does that mean? So also that green and sustainable taxonomies are being developed worldwide, but there are no too little obligations to use these stricter standards. So this is a question on standards which Celine could also answer, but I think let's start with you and then move on.
Yeah, thanks. No, it's something that I was quite interested in the research. I mean, one of the points about the ICMA standards is that when it comes to things like green, they don't define what green is. It's very difficult to define what green is, but they are very flexible. So of course they have created this problem of greenwashing, and they're trying to respond to that. I think there's a massive crisis in credibility in these bonds as well. And maybe I didn't get that across in the presentation, but a lot of industry news magazines and reports, even from people you would expect to take them seriously, don't really take these ESG bonds seriously. So I think the ICMA, which is working with the World Bank and others to try and promote these ESG bonds, they're facing a massive credibility crisis. The European Union's green bond, I think, is interesting, very complicated, and I don't think I could cover that in detail here, but there are differences between the European Union's approach and the one that the ICMA has been using for years. And in theory, the European Union's approach is more robust. In one area, it allows for companies or issuers, whether that's a company or a bank or even a government, to be brought to court for lying, not delivering on their promises. So it's making these bonds a little bit more formalized, but no one really knows how this is going to work. And there's no cases, no successful cases really of a big ESG bond being sued by, let's say, other investors. But I think there is tension in the market. How long can these voluntary labels go on for without any credibility? And I don't think, well, I think maybe we'll be amazed that they managed to survive for so long, which is a sad thing. Then there was a question related to that about, yeah, I'm just reading the question. So I wasn't able to answer directly in the tie. I'm just asking from Lars Jensen, what is the panel's views on the prospect of bond models being supported with official sector credit enhancements? Well, I think we're already seeing that, and it opens up a number of interesting points, and an area which Eurodad and Latindad have done a lot of work, if I understand this question correctly, is on some of these blue bonds, which have been linked to debt swaps, where the American government has provided credit enhancement facilities. And it's really confusing how this would work in a moment of default. Really, would the US step in and actually bail out these countries if they couldn't afford to repay? And the little I know about this, because it's very opaque, is that they're quite restrictive clauses, so they don't actually help out with default as much as people think. But they may allow investors in one bond to be prioritized in a debt restructuring compared to other investors. So they're quite controversial. But this ties me into a broader point, which links to a number of questions that I've seen posted. People are asking, can you get information on this? Can you know how much money is being made? Who are the investors who are buying these bonds? And I think as civil society organizations, we have to appreciate that this area of work is so difficult to research because it's very difficult to get access to information. And when we're asking, well, what should we do? As a researcher, I find it quite daunting, the thought of all the work that needs to be done by researchers and civil society organizations to monitor what's going on in these markets and how difficult it is to get access to information. I find it impossible to locate people who work in selling these ESG bonds to investors to get them to do an interview. I have no idea. I can't find anyone who would talk to me. Whereas, I used to be a criminologist and interview gangsters in South Africa. I could find it much easier to have an interview with a gangster in the ghettos of South Africa than I can with a bond trader in London. And I think that is something we really need to reflect on, that we don't have access to this world. We don't speak their language. We don't have access to their information. Even things like Bloomberg News or some of these other industry news sites, you have to spend £1,000 a year to get access to their basic news. I've done it for a few months and then I can't afford it. So we are struggling to monitor this and stay up to date. And it is a very alien world to most of us. And we've all seen how difficult it is to keep other NGOs, grassroots organizations, indigenous peoples groups. We do these webinars all the time where we're saying, okay, we're going to explain to you how these complicated financial instruments work. We often fail, personally, always, in being able to make this understandable and relatable to people. So I think there's a massive challenge when it comes to how we deal with these in terms of understanding them and communicating this financial jargon to the people it's affecting the most. Would the panelists agree with that?
Thanks, Andre. I can see everyone is nodding. But I'll just move on to the next questions, which are also linked to this one. So there is one for Celine by Pablo, who's asking how the switch from private to public finance could be a different form of external domination on developing countries instead of a more tough one. So this is to do again with the shift that you already mentioned, Celine.
Yeah, thanks, Pablo. I'm not entirely sure what you're asking in terms of whether it's just a different type of domination or a like a more egregious one. I'm just it's going to be different. I think Andre's last point just illustrates one of the problems with this shift, which is the issue of transparency, and that is one of the biggest risks, right? Like, so if a country, we're already having serious problems with, calculating debt sustainability because you can't get access to, if debt is hidden, you can't access that information. And I think the same thing goes for these, when you shift from a concessional loan to, financial markets and issuance of bonds, you just don't know what the terms and conditions of that financial instrument is. It's not publicly available in the same way as if you searched on the World Bank database for a project. It's just not there. And I think civil society has worked for decades to push the World Bank and other MDBs to make project financing available through databases, and it's searchable and you can find them, and you can do analysis based on that. But if you haven't got a repository of all the GSS bonds and all the terms and conditions, particularly when it comes to performance-based loans, you're gonna, like, there are conditions attached to it. You have to do certain things and that will increase or decrease your debt, as Andre's report showed. But there's no repository of it. So how can you, account keep the government to account for that, the types of agreements that governments sign up to? There isn't a database, there's no repository, so that's significant. But the other more important thing is that a lot of international financial regulation takes place in private and very closed door, industry dominated fora, and that is a form of excluding not just civil society, but really excluding developing countries also from these, because it's not as transparent as, we can, multilateral trade regimes or, trade agreements, public international legal agreements, which are treaties. And, so you'll have your trade treaties or your investment treaties. Those have to be negotiated in pretty public spaces. They have to go through, domestic legislative processes in most places. The executive would need the approval of the legislature in order to enter into these agreements. We have problems with, financial instruments being, part of, the executive order, and therefore it doesn't have to go through Parliament, etc. So we have that problem with IMF and other forms of lending anyway. But this just increases the opaqueness of that whole process, right? Where you're not being able to evaluate, scrutinize financial agreements that are entered into for governments that have very important, not just financial implications, but also if those terms and conditions affect communities which live in coastal regions, because you've signed into a blue bond that perhaps prohibits their right to fish, in their regular fishing areas, then those communities are going to get access to that information to be able to, input into whether they think this blue bond is a good idea or not, right? And I think the other thing that we need to remember as well is that these are, again, as I said, the financial sector, financial actors are going to determine what constitutes a lucrative investment for them. And this is also tied into domestic jurisdictions where those financial actors are based. Because if you want pension funds, and you're trying to get pension funds to invest in these GSS bonds, those pension funds have to be regulated by the pensions regulator in their respective countries. They have to follow, those standards that are being set in those jurisdictions. And that's the same for asset managers, etc. So, and developing countries will never have any input into those standards because they're not, based in the UK. They can't influence legislation on pensions reform. They can't influence, legislation on, investment firms in the or banking sector, they have no control and input into the Financial Conduct Authority in the UK. So the move towards private as opposed to public finance has massive implications, because developing countries just literally are going to be, it will intensify their position as rule takers rather than rule makers in the global financial system and the international economic order.
Thanks, Celine. This is really helpful. I'm also wondering who has authority over the Financial Conduct Authority in the UK at this time. But yeah, thanks for the reflection. I have two questions now, which is one is from Yufeng Li for Yolanda. Maybe you can take this, Yolanda. She's saying there is currently no standard understanding of what constitutes or is included in the term ESG, either at national or international level. If it's possible, would it be a good idea to have an internationally agreed definition or metrics for ESG, which could then be applied to bonds? And it would be helpful if you could also attach this question, Yolanda, with the role of civil society, because we've been talking about it a lot. Considering there is a diversity of views on ESG bonds among CSOs, how do we move forward on that? Thanks.
Thank you. Thanks a lot. And thanks, Yufeng, for the question. Because I do think there is a role for us for civil society, but also development institutions to work on, what would be considered green or ESG. So to work on a great definition of metrics, but not to fool ourselves, because that won't be enough. I think there is a comment from Miriam in the chat, and I think the report is also very clear, and Andre has been, and Celine, very, very clear on this. The problem is that the system is all based on voluntarily. Issuers and buyers voluntarily agreeing on one standard or the other, or non-standard at all. So there are no actual rules that there are no obligations or little obligations to stick to this standard. So even if we manage to put out there something that we consider the right standards or the right taxonomy, we still need the structure. We still need the structure that obliges somehow issuers and creditors and buyers to stick to those standards. I know with Yufeng Li, we have discussed several times that it would be a good moment to review that idea of responsible lending and borrowing principles, including what does it mean for financial markets, what does it mean for the ESG bond market to apply responsible lending and borrowing principles. And that links to the other question on the role of civil society. I think our role would also be to put out there proposals that that develop that financial architecture reform that we want to see out there. So that develop those structures that would make, I don't know if ESG bonds to work, but at least to do no harm and to be accountable and to be transparent and to fulfill that idea that Andre said at the beginning, which is like, well, these bonds can be better than vanilla bonds. Let's make that happen. And I think the way forward is to push for that regulation and for those structures. And this is civil society role, which is pushing for international financial architecture reform, put it in very simple terms. I think the other issue is also to find out a little bit more, and here is what Andrew was asking. It's very difficult to find the information. So pushing for transparency is also something that we need to do more. I'll leave it there. Thanks.
Thanks. And one question for Carola, and then I come back to you, Andre. And the question is, what are the alternatives to such instruments, given that global South countries are in need of sustainable financing? And if you could also reflect on Yufeng's inclusion of ESG or transformation of ESG as a term, that would be very helpful.
Yes, thank you, Farwa. First, to reply to Yuyen's question regarding the ESG definition, I completely agree that there is a need to have one clear and agreed definition. and only one methodology to measure these flows, because otherwise there is not going to be transparency. This is happening already in climate finance. After 30 years within the UNFCCC Convention, there is not an agreed climate finance definition, so everybody can measure whatever they want regarding climate finance. That doesn't provide transparency. This is creating distrust between countries, and it is a problem, a big problem. And regarding what you were saying about the alternatives, I think considering the current debt situation that countries have, 10 highly indebted countries in my region in Latin America, the limitations that I mentioned regarding the UNFCCC financial mechanisms, the needs, the huge needs and financing gap that there is, we need to think about out-of-the-box solutions, other different solutions to really reduce this gap. And debt relief for countries in need should be one, involving private and public creditors, also MDBs that are important creditors in countries like mine. Moratorium and debt restructuring for countries affected by adverse climate-related events. Okay, that would be better than having these green bonds. Reformation of the current climate finance architecture. As I mentioned, we need to leave neocolonial instruments behind and increase the use of accessible and agile public grants, especially for adaptation and loss and damage, which ESG bonds are not really responding. A reform in the international financial architecture, as many were mentioned, that could lead to a more democratic and fair financial system. A new allocation of special drawing rights. In Latin, that we are campaigning for new allocation and new issues and new allocation of special drawing rights, especially for the climate agenda, for the SDG agenda. But of course, it would be better if it could be done under a fair distribution criteria, not under the quota criteria of the IMF. And as I was mentioning, also the green taxes. We think that, for example, if we agree of international green taxes for the fossil fuel corporations, the big multinationals that are doing billions of dollars every year in profits, we could get a lot of money that could close this gap, and also to redirect military expenditures and fossil fuel subsidies to climate action and to the SDG agenda, because there is this narrative that there is not enough public money out there. So that's why the rich countries are not fulfilling their international commitments, but we can clearly see this money is flowing to the military expenditures, to the war, to the fossil fuel subsidies and investments, and this is only harming people and the planet. So this needs to be readdressed and needs to be really, this needs to go to fund climate action and the SDGs.
Thanks, Carola. And with this, we have one last question for Andre, and I think it's really important to clarify this question because in a way it was also at the heart of the report when we were first writing it, which is, if countries get no substantial financial benefit on the bonds, then why are some countries so keen on them? So for example, Uruguay and Chile, and what do they hope to achieve? So it's a bit of a psychological question as well.
Yeah, I wouldn't necessarily think that countries don't have anything, or governments have nothing to benefit from these ESG bonds. I think, on the contrary, what we said towards the end of the report is that there are vested interests in promoting these ESG bonds. A lot of industry people are making money off them, a lot of NGOs who make money out of them as well. And for some governments, I would imagine they're very easy instruments, much easier than doing something, talking about green taxes or reforming how natural resource sectors work. It can be an easy option to get a lump sum payment, which, often it takes 10 or 15 years before it needs to be repaid. At which point they're not in government anymore. It's someone else's problem. So I think that it's very easy to understand what attracts governments, or some governments, to these type of ESG bonds, and not even including some the potential for bribery and embezzlement that goes on, which we know surely there is in a number of these. But I think what's disappointing when you look at how ESG bonds are marketed to countries, there's a very superficial analysis which is all it's very optimistic that this bond will be invested in a way that will promote growth, that will allow the countries to repay the bond payments. When we know that under scrutiny, this doesn't make sense in a lot of sectors. Again, going back to the area where I'm most familiar with in the ocean, a lot of ocean economy sectors like fisheries, they don't produce surplus profits. So the logic that you can invest 50 million into the ocean economy and then pay off with interest over the next 10 years, you have to ask, well, where's this money coming from? So I think that, there's short-term interest behind these ESG bonds. They're easy financing in certain situations. But going to the question of how we can improve the standards and how civil society can engage, I think there's an awful lot of things we can do in terms of, particularly at the country level, in getting a more coherent view of how these sectors are going to be funded, what are the funding needs, how they can be reorganized, and then ask the question, in this instance, does an ESG bond really make sense? Because it's expensive debt. It's a gamble. And I think, I did a report for groups in South Africa on fisheries and blue bonds. And just happened to mention in a webinar, you do know that this money is going to be paid back with interest. And it was almost people had forgotten that it was just money, like it was just donor money coming in because it had a nice label. Whereas in fact, if you break down what are the repayment structures, I think this was one of the questions in, how do we know how much money is going, in these instruments? And what I was doing in that workshop was to say, the UN is promoting ESG bonds to pay for protected areas in the world. And they're saying we need $180 billion every year for the next years to go into protected areas. And I was saying, well, that's great, but it's $180 billion plus interest going back to the rentiers in the north. It is a transfer of wealth that is taking place. And if people can understand it in those terms, it changes the dynamics. If we were to finance climate and biodiversity on ESG bonds, we are transferring an awful lot of wealth to the north. And what is the implications of that?
Thanks a lot, Andre. This was it was very important to mention this. So we're just at time, and thank you so much to the panelists, and thank you so much to the audience for attending. We will follow up with this work, and if anybody is interested in follow up on questions or more information, please do get in touch. Thanks a lot.
Thank you. Thanks a lot, Andre, as
Thank
well,
you.
and Celine and Carola.
Thank you. Goodbye.